Welcome to Investors Insights, where today's topic is rates are the story. A lot of news over the weekend and last week around rates falling. Trey's going to talk about that. I'm going to talk about the seasonality of September, and then Ty's going to talk about the importance of consumer spending. So, Trey, everybody's talking about it. Rates are finally falling. Tell us why this matters and give us an update on rates.
Yeah, thanks, Bobby. So we got a disappointing jobs data out on Friday, and that caused the long-term interest rates to fall. And why that's important, and that's what people are talking about, is the 10-year Treasury yield really moved from 4.3 down to below 4.1. And that's a pretty big move. And that's important because the long end isn't really as connected to the Fed. That's more market-driven. And a lot of people are expecting the Fed to start cutting in a couple weeks on their first cut since last year. But last year, when the Fed cut rates, long-term interest rates, the 10-year Treasury, 30-year Treasury, and the 30-year mortgage all went up as the Fed cut rates in reverse response. So every time the Fed cut last year, long-term rates went up. So that's saying the Fed may want rates down, but the market wasn't ready to digest that thought at that time. So it actually had a negative effect. What we're seeing now in anticipation of the Fed cutting rates in a few weeks is the long-term interest rates already coming down. So that's a positive sign because that could bleed through to mortgages, bleed through to housing market, and have a positive impact on the economy. When the Fed cut rates last year, there really was no follow through in economic activity output because when most businesses and individuals don't borrow on the short end. They like long-term decisions. So if long-term rates don't come down, it really doesn't have that positive flow through to the market. So markets are expecting between 2 and 3 rate cuts between now and the end of the year. And so it's very important to see that. We could get a reverse of all this, though. Everything's pending data. We get the consumer price index, CPI, and the producer price index this week. Both will be announced. Both will have massive impact. Right now, because the jobs picture, the Federal Reserve has a dual mandate of full employment and stable prices. So that's inflation and jobs. Jobs were a little weaker, so that's one of the Fed's mandates would indicate the Fed should cut rates, try and boost demand for jobs. But the other one is just important, if not more, in many people's eyes, is inflation. So if inflation remains higher than the Fed likes, that's going to limit their ability to match both mandates. And so they'll probably still cut in September, but it may reduce the long-term expectations. So we'll see this week how much this drop in yields does it have staying power going forward.
Yeah. So again, rates are the story, and market analysts have widely considered September as a tough month for the market. And while overall returns have struggled in September, it's important to look and see why this year actually might be different. And you can see in this chart that covers historical market performance in September since 1950. And on the left column, it shows that the average return for September has in fact been negative 56% of the time. But I want to point out why this year might be different, and it has to do with the second column of the chart there that shows when the market is above its 200-day moving average, like it is today and like it was coming into September, then September has actually produced an average return of 1.3% for the S&P and a positive over 60% of the time seen in the second column there. So again, while market volatility has picked up in recent weeks, the market is still trading above its 200-day moving average. And with the positive earnings growth and falling rates that Trey just talked about, we are encouraged that September could be set up to be a positive month. So something we're watching carefully here. And then Ty, we talked about it. Lower rates, that is good for the consumer. Talk about consumer spending.
Yeah, well, the consumer, makes up 70% of GDP, makes up 70% of our economy. So we always want to keep an eye on the consumer. We got some data out. This is the trailing 28-day year over year change in consumer spending. So the last 28 days, how did this year compare to last year? Why is this an important time frame? It's back to school season. So typically you see an uptick in spending. It's an easy comparison. And so the back to school season was really good, up 2.5% year over year. Usually is a precursor for good holiday spending. Of course, we're getting ready to approach the holidays here at the end of the year. But with that being said, there have been some surveys that have shown holiday spending may be down this year. Reuters put out an article. PwC did the polling. Now, keep in mind, they only polled 4,000 U.S. consumers between June and July, so not a ton of data there. But they're expecting consumer spending for the holiday shopping season to be down 5.3%, which would be the biggest decline since COVID. They're expecting about $1,500 per person to be spent. As you can see in this chart here, typically it gradually rises not only with price increases, but people's sentiment on the economy. And they mainly blamed Gen Z, and they blamed, kind of the outlook on inflation and the outlook on the economy. So some, differentiating data there, where one is telling us that maybe holiday shopping season will be good. Reuters, of course, putting out the article that it might be down. So we certainly want to keep all eyes on the consumer as we head into the end of the year here, because again, it's a vital part of the economy.
Yeah, so hopefully lower rates will help consumer spending with holiday season coming up here. So again, rates are the story. Something we're watching carefully here, watching for the Federal Reserve to see what they decide to do around cutting rates. A lot to talk about. So if you have any questions on anything we've discussed, call us, email us. We'd love to hear from you. Have a great week. Thanks.